So you want to learn futures trading. Maybe you want to be a futures trader. Maybe you want to make it part of your investment trading plan on the side. Whatever the reason, this short course has you fully covered. I've been using trading futures for nearly 30 years now, so hopefully you're in the right place to learn all about futures trading. I'm going to cover all of it, from a bit of history through to the specs, how you trade them, some strategy ideas, the whole lot. It's all in there and it's waiting for you to get stuck into. So let's get on with it. Before we do kick off though, let's summarize what you will be learning. Well, as I mentioned, the origins of futures trading, what a futures contract is, how it works, how to actually trade them in practice. You need to know all the terminology, all the key points that make the futures market work, from tick size, point value, leverage, margin, the maths behind it. Very importantly, how margin works, initial maintenance margins, breakdown of the top futures market, so commodities, indices, that sort of thing. Some futures trading strategies are very popular at the moment. What platforms and brokers to use, also very important for keeping your money safe and getting the maximum out of the futures world of trading. How you go about opening one of those accounts. We look at the fees, the account types, the data feeds, and what I'm seeing massively growing at the moment, funded futures trading accounts. We're going to have a quick look at those, how you'd get started, the advantages and disadvantages of going down that route. I'm going to look at some risk management rules to keep your money safe around stops, position sizing, and then going to look at a few mistakes that new traders make when trading futures and how to avoid them. Plus I throw in some top tips to help get you on the right track, and then we round up with the next steps. Once you've digested all this lot, what do you do next? Now, before we get going, I want to show you a quick clip from the film Rogue Trader. It's about a guy called Nick Leeson who crashed Barings Bank, one of the oldest, most prestigious banks in the UK, from his activities in Singapore and futures trading. But in this clip he does explain futures trading very well to his cohort of new colleagues learning the art of futures trading. And take a look.
A futures contract is an agreement to buy or sell a specified amount of a commodity at a specified price at a future date. It's like if I agree to sell you this cup of cappuccino, which I don't yet own, at 45 cents a month from now. If I can buy the cappuccino at, say, 43 cents, I make a profit. If the price goes the other way, I have to pay more and I lose. It's timing. It's buying and selling at the right moment. Sometimes espresso might be the best deal, or salt or pepper.
So, we're running a supermarket?
The truth of the matter is, we're not buying and selling anything real. It's just numbers. In our case, contracts based on the value of the Nikkei, the Tokyo stock market.
I really love that explanation, but don't worry if you didn't get it. It'll all make sense over the coming course. But first, a bit of history. So we've got to start with a bit of history, and in particular American history, and we need to do that to get a full understanding of how the futures market and trading has developed, and it's critical for your understanding of how it now works. Now, if we take ourselves back into the 1800s, the US was predominantly a East Coast focused country, and then for many reasons they pushed west towards the Pacific, and in between that a lot of pioneers found grains, mining, cattle, all sorts of commodities that could expand the growth of the US economy, feed the US economy and population as it grew and developed. Now, think about this logically. If you have a commodity, let's take corn for example, you've got to get it from the maybe the fields of Kansas to maybe an end user in New York or Chicago, somewhere else that wants to turn that into cereal or whatever. But how does the person from New York say know what they're actually getting, the quality, the size, the standard, all those variables before it comes to delivery? What day is it going to get delivered on? There's so many different variables, and in those days it was very difficult to manage that process. So it needs standardizing, and this is where exchanges came in from New York and in particular Chicago, and they created a concept that put those buyers and sellers together, and that helped alleviate the risks from both points of view. The seller knew what they were getting from the buyer and vice versa. And as you can tell, this was heavily commodities driven to start with, and as the US economy grew, so did those futures markets, and famous exchanges like the Chicago Board of Trade really flourished and pushed on. And then we bring ourselves into the 20th century as financial markets really took off. Financial institutions, the exchanges, trading companies realized that you could add more futures markets on different types of product, maybe financial products, financial markets like the S&P 500, stock markets, the FTSE 100 over in Europe. The 20th century really saw a takeoff of futures trading around the globe. Forex, bonds, interest rates, all of these products can now contain futures contracts, and in the last 5 to 10 years we've seen a massive growth in cryptocurrency futures. So you can see now the market for futures trading, which initially started in the world of commodities, now encapsulates so many different markets and gives us as traders some great opportunity to create really highly effective, profitable strategies around those markets. So like I say, very important to understand the history of the markets, because it will help you understand how these futures work and trade at the moment, their peculiarities, the detail that you need to know. First thing we need to know is that a futures contract is a derivative of some underlying asset. Like we've seen, it might be corn, it might be oil, it can now be crypto or the S&P 500. So as it says there, a derivatives contract is an instrument whose price depends on or is derived from the price of another asset. So we know it derives from another asset, but what exactly is a futures contract? It is quite straightforward really. It's a contract, basically a financial contract obligating the buyer to purchase an asset or the seller to sell an asset, like we say, a physical commodity, a financial instrument, at, and this is important bit, a predetermined future date and price. And those contracts will also detail stuff like quality, quantity of that underlying asset. They're standardized to facilitate trading on futures exchanges like the CME or ICE. Forwards, you might have heard of them as well. They're the same as futures but not exchange traded. I've got a couple of examples to show you of what a modern spec of a futures contract looks like. This is from the CME exchange, and first up we have corn. Notice its units of 5,000 bushels. It's priced in US cents per bushel. You can see the trading times, the minimum prices, the contracts that you can trade in terms of futures settlement period, a method saying it's actually a deliverable type of futures contract. So a lot of information. There's more information there on the contract. And our second example from the CME is for copper, and notice this one's quoted in pounds. So it's 25,000 pounds of copper for one contract. You can see its pricing, the futures, minimum price movements, contracts, the whole lot. It's all in there. If you want to investigate further on these sort of things, have a look at www.cme.com. Now, key term here, physical delivery. Now that means if you left that futures contract to expiry, you might get delivered whatever you have been trading. So it could be oil, soybeans, corn, rubber, whatever it is, and you probably don't want that to happen unless you're an end user, like a factory plant, your manufacturer, that sort of thing. The other flip side of it is some are cash, financial settled, so there's actually no physical delivery involved. So something to watch out for there. And some other sort of fun futures facts before we get into the detail of them. Futures contracts use high leverage relative to, say, stock markets, and well, initially they were really used as a hedging product. And what does hedging mean? Well, that's down the bottom there in red, a trade strategy designed to reduce risk. Or the other flip side is futures are used to speculate on price movement. So two options for us there for usage of futures, which we'll look into in a lot more detail as we progress through the video. You might have already picked up that these standardized contracts need to be controlled, monitored, facilitated from some fixed location, and that is done through what we call the exchange. And historically they've been regional to the markets that they are involved in, for example in Chicago and New York, but they're all over the globe as well, London, Paris. What you are probably familiar with is seeing all those guys shouting at each other. That's futures trading, and they're called trading pits, where they basically putting buy and sell orders together to facilitate the flow of whatever market they're getting involved with. The pits unfortunately are fading out, and most have become computerized, and the world of futures trading is pretty much dominated by two US owned exchanges, one called the CME and the other ICE. In the last 10 to 20 years both of them have been hoovering up, sucking up other minor smaller exchanges. And for example, CME has bought COMEX, which is metals, CBOT, NYMEX, which was like your oil. ICE has bought IPE, NIBOT, WC, TSX, Canadian One, the New York Stock Exchange, Euronext. So, quite a lot of consolidation in the futures world. And the other big growth market at the moment is out in China. They've got quite a few futures exchanges, but the Shanghai Futures Exchange is probably one of the biggest ones that you might want to get familiar with, but very difficult to access and trade through. So a brief look at the CME and what products it can offer. Their website is well worth a visit if you want to learn more about futures, but as we can see here, just a really quick overview of the sort of markets they offer. You can see a list of major popular ones down there on the left: corn, soybeans, crude oil, S&P 500, but you can also see the sectors, areas that are involved with agriculture, energy, equity indices, FX, interest rates, metals, options, a whole host of futures markets that you can trade. And their main competitor, the ICE exchange, what do they offer in terms of markets to trade? Again, a lot of choice, credit default swaps, metals, indices, interest rates, energy. And I just clicked on agriculture there so you can see the sort of markets you got there: canola, cocoa, coffee, cotton, sugar. It really does give you an exposure to markets you can't really normally get your hands on. So now let's step through a simple example of how a futures trade gets put together. Now we've got an example using a metal, and that metal is copper. Now it used to be traded on the COMEX before the CME bought them up, and in this example trader A wants to buy 1,000 lots of copper from the COMEX, and he wants it for his company's infrastructure product and wants the copper delivered. Now one lot, as we know, equals £25,000, and the current price is 2.7855. Now he goes to the COMEX exchange floor, and at the same time trader B wants to sell one lot of copper. Now he's a speculator and he thinks the price is going down, so he's quite happy to sell. So he also goes to that COMEX exchange floor, and it's the COMEX that puts the buyer and the seller together. Now trader A and trader B have been put together under the contract through the COMEX for this copper trade. Now eventually they'll want to close out the trade. We know that trader A wants to keep it through to expiry to get the actual physical metal, whereas B wants to close out just because he's more interested in the price movement. Now if it has gone down, he's made money and he's happy, and the details of the delivery will be in the details of the contract published by the exchange. Now do note that trader B is not obliged to deliver the metal. He's just the other side of the contract. He can close out any time and someone else will take his place. It's that job of the exchange to keep that whole process in balance. And that brings up an important point about market size. Some commodities are very small and don't have a lot of volume and interaction, buyers and sellers. So if you're holding something and there's no one to sell it to, then you might have to wait a bit of time to get your order filled, and the price might slip accordingly, on how desperate you might be to get out of that position. So that's always worth bearing in mind when you are trading futures. But most, though, are of a decent size where orders get fulfilled very quickly. Now, futures markets come in all shapes and sizes, and understanding the difference between the full, mini and micro contracts very important to help you scale up your strategies, manage risk and choose the right product for your capital. So there's pretty much 3 buckets to consider, which we'll look at briefly now. We'll start with full size contracts. That's known as the standard futures contract. This is the original and the biggest contract size, and for those with deep pockets, all offered on exchange, and they're really for the institutional trader, the hedger and the large speculator. Why? Because margin is pretty big on these guys, and carries large tick value and exposure. So not beginner friendly. One tick can be $50 to $100, and got some examples there on the S&P, gold, crude oil and corn. Now imagine these guys as your mid-sized contracts. They're called the E-mini contracts, and basically they were designed to give access to smaller players into these large markets. They're much better for retail traders with reasonable size capital in their pocket, smaller tick values, lower initial margin than the full size contracts, very liquid and often more popular now than even the full size contracts. Some examples there. S&P 500 at the top showing the tick size, and we've got the Nasdaq, the Dow E-mini and gold, which is half of the full size. So they're a scale down from the full contract. And then we've got our last bucket, the micro futures contracts. They're designed for newer traders or pretty small accounts, normally about 1/10 of the size of the E-mini contract, but always check out the specs. Lower margin, lower risk per tick, great for learning and testing strategies or precise scaling. Very popular in the funded futures world as well, and as it said, they're growing in popularity due to accessibility. Some examples there, just showing you, for example, the top one there, the MES, that's the micro S&P 500, which is $5 per tick, which is a tick size of $1.25. So what does contract size matter? Well, it affects the leverage, the margin, the tick value and the P&Ls are very important when selecting your contract to trade. It does allow position scaling. You can split entries with micros, for example, get more precise in there, and helps you align contract risk with account size and strategy. And micros, which like I said are really growing at the moment, are perfect for low risk learning and strategy development. So let's just summarize futures contract size. You can see the full there, that's 100% of the value, and it's best for institutional traders, pros. Got some examples of tickers there on the right hand side. Then the E-mini in the middle, 20 to 50% of the relative full size, and then micros normally 10% of the full size. Great for new traders and precision. Some examples there. Notice the M in front of the ticker there to signify that it's a micro. Now, I'm in this website called barchart.com just to show you the sort of contracts, markets that are available to you, and there are loads of them. Now this is just one snapshot. These are US based futures, but wherever you are in the world, China, Europe, there's lots of different exchanges trading futures contracts. But Here we got some examples. We got grains, we got energies, we got metals, livestock, softs, indices, currencies, financials, absolutely loads to pick from. Want to pull up on a couple of things as well. You can see the contract name there, and you can also see the symbol. That's the ticker. Now in this top example we got ZC Z25. What does that actually mean? Well, the ZC is the corn part, and as we will see shortly, the Z25 is code. That actually means December 25, and that's when the contract expires, and you can see that in the contract name there. Now there are lots of futures contracts, say for corn, running out into the future, not just December, and again we are going to dissect the futures forward curve later in this video, but for now I'm just going to take you again back down through that list. You can see energy, crude oil, metals, gold, livestock, live cattle, softs, cotton, sugar, absolutely loads. And if I click over here for the market overview, we will hopefully see the sort of volume size we're talking. And you can see on volume, you can see for example the 10-year T-note, highest traded in volume at the moment. S&P 500 E-mini, one of the most popular contracts there is, nearly 700,000 lots within the first 2 hours of trading today. And you can see other popular ones: NASDAQ, crude oil, corn, gold, nat gas, soybeans, coffee, cocoa, they're all there. And going back to the futures list here, again we saw ZC Z25, but notice every different market has a different ticker. First two letters, CL are for crude oil, RB for gasoline, GC for gold. Some make sense, some might take a bit more translation, and then we've got that code part stuck on the end to let us know when that contract is expiring. And you can see, like for example, cotton there, CTZ25, December 25, that's Z25. But like I said, we'll see that in more detail in a second. So these are the most popular futures trading markets in 2025. They're the go-to markets for retail, prop and institutional futures traders. What I based this on: volume, volatility and opportunity. Let's take a look. In first place with gold medal, the S&P 500 E-mini, ticker ES. It's the most traded equity index future globally. Massive liquidity and volume every day. Very popular for all sorts of trading strategy. Brilliant for technical analysis and trend following strategies. Has micros available as well, ticker MES. So if you've got a small account, it helps there as well. And it is all on the CME. Then with the silver medal, we have the NASDAQ 100, ticker NQ. It's the E-mini contract, another stock market, more volatile than the S&P, tech heavy weighted, very popular with day traders that are maybe a bit more aggressive. Also, tickers MNQ, micros there, offering flexibility for sizing. Then in third place we have WTI crude oil, ticker CL, globally traded commodity benchmark. A lot of volume, good daily moves, a lot of news and information that you can trade around as well. Can have explosive volatility, so great for momentum and breakout traders as well. And it is heavily participated by the big guys, institutions, energy firms and retail, all in there together. And in fourth place, we've got another commodity, gold. It's seen as a safe haven asset, reacts to inflation, US dollar strength, geopolitical risk. So a good one to get involved with. Very popular and grown in popularity in the last couple of years. Very strong seasonal macro cycles. Popular with both fundamental and technical traders, and active pretty much nearly 24/5 around the world at the moment. Micro contracts as well, so beginner friendly, ticker MGC. Then I've got the next four all bundled up together on this page. Stop it, zoom in if you want to get more detail. But number 5, 10-year Treasury notes, ticker ZN, core US government bond future, very, very big volume. Volatility increase with interest rate cycles, so things like non-farms, FOMC, that sort of thing, inflation. Popular for yield curve trading, spread strategies and macro hedging, but you do need a knowledge of interest rate mechanics for that one. Then I've bundled up this lot at number 6, and we've already talked about MES and MNQ, but you know, these micro mini contracts really booming on the CME at the moment. Great for small accounts, you know, more specific risk management style trading. Very popular, like I said, growing with the prop firms as well. Same tick size structure, about 1/10 of the size. Very big growth since 2019. Now dominated by retail futures volume. At number 7, we've got corn and soybeans, 2 grains there, heavily traded on the US seasonal. Great plays there around, you know, the peculiarities of those markets, planting, harvesting, USDA reports as well, commitment of traders sort of analysis that we'll look at shortly, and it also influenced heavily by global trade, especially say China with soybeans. Popular amongst fundamental traders and spread hedging strategies. Very liquid as well during US trading hours, not so much out of that. And then finally, a new player really to this setup, Bitcoin. CME have got futures contracts now, regulated futures contracts, which make this a very good legitimate product to get your hands on and trade, attracting big institutional, retail and algo flow into that market. Very volatile, but the upside to that is you can get higher returns, but also always be careful for those big spikes and, you know, potential losses, so always do your risk management. And, you know, prefer to spot crypto for hedging and shorting and leverage, and wider spreads and higher margin than traditional futures. We've got a few honourable mentions as well. We've got the Russell 2000, another US stock market. We got the Euro, FX, probably the biggest traded currency out there. Nat gas, another energy sector play, seasonal moves, weather sensitive, high volatility. You've got the VIX related to the S&P 500, and then rounding up there, copper, ticker HG, very China sensitive and global growth indicator. So that list should be good to get you going in the world of futures. But what are the key factors that make a futures market popular? I've summarised them here. We've got liquidity, you know, equals tighter spreads, better fills, lower slippage. Volatility, opportunity for profit. Volume, clear setups. Momentum, easier execution. Leverage efficiency equals, you know, better capital use per contract. You know, access to micro mini sizes, that's going to let in all those smaller accounts, so giving access to everyone. And correlated global factors, you know, makes the market relevant to news and data. So those factors, you know, when you're thinking of a market to trade, are you ticking the right boxes? Because they're going to help you massively in your trading success. Futures markets and trading does have a language all of its own, and I'm going to take you through some of the key, you know, bits of terminology in that area. Now, first up, contract size. I think you can guess what it probably means. In our copper example here, one contract equaled £25,000 of high grade copper. If it was corn, for example, it would be that 5,000 bushels that we saw earlier as well. The underlying asset, what does that mean? Well, we've worked out that futures are a derivative product, so it's the underlying asset. It could be copper, it could be oil, it could be a stock market, but that, you know, information that's key to the contract, the quality, grade, weight, size, delivery, dates, you know, trading hours, all those sort of things are all included in the contract. Next up, delivery. What does it mean? Well, remember, most contracts do not get delivered on and are closed out prior to expiry, maturity, and all the delivery arrangements are specified in the contract. Remember, some users, the commercial users, might want actual delivery of that underlying. And very importantly, all these futures contracts have contract dates, and it's normally done by a month and a year, and the exchange must state the precise period when delivery can be made. In this example, HGZ8 quite simply means at the time of putting this together that it's for copper delivery December 2028. Confusing? It is to beginners, but I've put together the code cheat sheet list for you. So each month has its own letter. Now, an example. Let's take the top line there in January for WTI crude oil. The code letter would be F, and if it was this year expiry, that would be 25. So Jan 2025 crude oil would simply be CLF 25, CL being the ticker for crude oil. Some other key date terminology you need to know. Firstly, daily settlement. Well, that occurs at a set time daily, can depend on the contract, but it's, for example, mostly 4 p.m. EST for CME equity futures. And this is used to calculate market-to-market profit and loss and margin requirements, and can affect margin calls and available buying power on your trading account. And the price is determined by an official settlement formula, not necessarily the last traded price. Now, don't forget, futures contracts have a finite lifespan, so when traders are exiting the expiring front month, that's the one with normally the most volume in it, and enter the active contract, what a lot of the traders are doing, probably either getting out beforehand or rolling it over, hence the contract rollover terminology there. And most rollover happens between 5 to 10 business days before expiration, and it's normally on a volume shift when the next month overtakes the current. It's obvious when you see it on your trading portal. You can do this often in your broker platform by setting up a automated rollovers, or you can do it manually. But a couple of tips there: avoid holding positions during illiquid rollover periods, because this can increase slippage. And if you want to continue holding your trade, don't forget to roll it over, or it will get closed out. Now, expiration last trading day. Well, that's the final day the contract trades before it's settled or delivered. It varies by product. Some may expire mid-month, others the last business day. But big tip for you here: unless you fancy having, for example, if you're a wheat trader, 5,000 bushels of the stuff delivered at your doorstep, do get out of physically delivered contracts before the first notice day. And also note, expiry day is not always the last day of the month. Now, just going back to first notice day, because it's important, that is the day when delivery notices may be issued for physical contracts. Remember, traders who don't want delivery must exit before FND, and this applies to things like gold, oil, grains, etc. So check whether your contract is physically or financially settled. Last bit on dates for the moment. The final settlement date, well, that is when the contract is fully settled, whether it's cash or physical. Some contracts settle to an index price, auction, or an average over a period, and it's important for accounting and strategy closure. So always have a mental note in your head what the final settlement date is of the contract you're trading. I'm afraid the terminology doesn't stop there. There is a lot to get through. It's all very important, I will say that. Once you know it, you can, it's in the old brain cells. You don't have to worry, but it's critical that you understand how these futures contracts work if you want to trade them successfully. So let's crack into a bit more detail. Now, we've got a couple of exchange-based limits here. Now, they're always monitoring what's going on, especially if there's the potential for market crash, big moves, volatility. Then we have the price movement limits. So contracts have daily limits set by the exchange, and if broken, normally trading ceases. And also there's position limits to stop individuals influencing the price. You're restricted to holding a particular size in any one asset. Now, we have already talked about physical settlement, but I just want to go over cash settlement and then compare that versus the physical settlement of futures contracts. Now, cash settled futures, no actual delivery of the underlying asset, very important. They're settled in cash based on a final index price fixing or formula. You might hear them also say financially settled, same thing. Most financial futures use this, for example, indices, crypto, FX, interest rates. Basically much simpler for retail traders because you don't get the delivery risk like you do on a physical futures contract. And the final P&L also is the difference between the entry and the final settlement price times the contract value, and some examples there of cash settled futures, the S&P 500, Nasdaq, VIX, Euro, Dollar and Bitcoin. Now going back to physically settled futures, as we know that involves actual delivery of the underlying commodity, for example oil, corn, gold. And if you hold beyond the first notice day, you're expected to make or take delivery. So really important for retail traders to close out before the FND or roll these positions before the FND. Physical, more used by producers, hedgers, institutions needing real asset exposure. And we're going to look into that, why they do that in a little bit. Can involve large storage, transport or delivery fees if not exiting time. Some examples: crude oil, gold, corn, silver, live cattle with their tickers beside them. So let's just summarize one versus the other in this table. You can see cash settled and physical settled columns. Delivery, none for cash, yes for physical. Common use, listed out some examples there. Final settlement, cash, financial for obviously cash, and you get the goods for physical. Trader risk, really only price risk, but for physical you're adding in delivery risk as well. Convenience, it's much more easier for retail traders. If you're retail trading the physical stuff, you've got to have contract awareness or it could spell a bit of trouble for you. There's just so many important concepts to get your head round, and here's another one. It's the minimum price fluctuation. You might have heard the term tick size before in futures trading. So what is the minimum price fluctuation? Well, it's the smallest allowable price movement a futures contract can make. It's set by the exchange and varies by contract, and each movement equals a specific monetary value, and that is known as the tick value. It's used to calculate profit, loss, slippage and transaction costs. So this is where it might get confusing. You might have heard the word, term tick, and you might have heard the term point. Are you getting the two muddled up? Well, there is a difference. The tick is the smallest price move a contract can make, for example 0.25, but the point is the full number move, i.e. 1 point made up of multiple ticks. So the formula there, 1 point equals number of ticks per point times tick size. Very important when you're calculating your risk and return numbers, and a whole host of other reasons, but very important to know. Here's an example for you using the S&P 500 E-mini contract, ticker ES there. We've got the metric tick size. Well, its value is 0.25 index point, and a tick value, well, that's worth $12.50 per contract. So 1 point move is obviously 4 times 0.25, giving us a point value of $50 per contract. So a really nice easy example to get your head around it there. So how will we calculate profit and loss on a trade, a position we're holding? Well, we're sticking with our S&P 500 E-mini example here. Now a 2 point move, that's our first example. So say the price we got in at is 400 and we want to get out at 4402. The difference is 2 points. 2 points is 8 ticks. 2 divided by 0.25, so 8 ticks times $12.50 is $100 per contract. So that's for a 2 point move. And then a 5 tick move, same process, 0.25 times 5 equals 1.25 points. We know that P&L equals 5 times 12.5 equals $62.50, either profit or loss. This might sound like a trivial part of the learning curve of futures, but it is very important, and it does matter because it's going to help you set accurate stop losses and profit targets, critical for scalping and short-term trading strategies, needed for position sizing and risk calculations, and affects total transaction costs. More ticks equals more potential spread slippage. So a really important set of parameters, ideas there to get your head around, because they are, like I said, once you get live trading in futures, very important. Let's look at a couple of examples now to give you an idea of what tick size, tick value looks like across different contracts. We've got the S&P at the top, we've seen that already, 0.25 tick size, $12.50 tick value. For example, gold is 0.1 and $10 tick value. Nasdaq there at the bottom, 0.25 and $5. Leverage and margin go hand in hand, massively important concepts. Leverage gives you more bang for your buck. Margin is the control mechanism behind that, really. We're going to look into both of those now. Leverage to start with, basically you're getting control of a larger position for a small amount of capital. In futures, you don't pay the full value of the contract, you just post a performance bond margin, which is a percentage of that full value. The downside to it, it magnifies losses, but the upside, it magnifies the gains. So double-edged sword. Expressed as a ratio, leverage equals contract value divided by margin required. Let's have a look at leverage in action. So we got a S&P 500 E-mini contract here, one contract, and the value for that is 50 times 5,000 points. That could be what the market is trading at that time. Gives us a contract value of $250,000. So that is a very expensive contract, and you can understand why you'd need a lot of money to trade that. But margin required is only 12,000 of that. So to work out your leverage there, we've got the $250,000 value for the contract divided by the 12,000 margin, giving us a 20.8 times leverage on that position. So you're only having to put down a small fraction to get that $250,000 exposure. So as it says there at the bottom, that means a 1% move in the index, 50 points in this instance, could result in a $2,500 swing on your 12,000 margin. So you can see how the losses could rack up quickly, but you can also see how the profits build as well, which is over a 20% gain or loss. So that is the power of leverage. So if you're a stock trader, you normally get 1-for-1 leverage. That's maybe why you have to move into the options world. But futures, you can get some really good leverage to get you into much bigger positions. So that brings us nicely on to margin. How does margin work in futures? Well, it's not a loan, it's a good faith deposit that ensures you can meet your obligations to the futures contract that you are trying to trade. And there are various types of margin. The first one we need to know about is initial margin, and that's the minimum amount required to open a futures position, and it's set by the exchange and based on volatility and risks, and only posted once per contract unless you add more positions. Like I said, it acts as that performance bond, not deducted, just held, like insurance policy. Now, example there, crude oil contract, say initial margin 5,000, you control 80,000, say, of oil with just 5k. Then we've got maintenance margin, and this is the amount you must maintain in your account to keep the position open. So about 75 to 90% of the initial margins, and if your equity drops below this, you're going to get your broker calling you up, and that is called the margin call. They'll be asking for more funds to top up if you want to stay in the position, or they can even close you out. So always be aware, like I said, of margins. Very, very important for your trading. Then we've got another type of margin, variation margin / mark to market. At the end of every trading day, your account balance is adjusted based on that day's profit or loss. So profits are added, losses deducted before the next session begins. This process is known as mark to market. So example there, you're long one S&P E-mini contract, market drops 10 points, you lose $500. That 500 is removed from your margin balance that day. Then we've got the concept of intraday margin, or aka day trading margin. Now, because of the cost of putting up margin, a lot of brokers out there, and now especially when trying to attract the smaller retail size accounts, offer something called intraday margin, which is often 80 to 90% 50% lower than the full margin, but what that means is you can only have it for a specific window within inside the day, and you've got to get out of that position as it says there in the example, because if you don't, then you revert back to full margin, and if you haven't got the full margin account, you know, out comes the margin call, you get liquidated. So an example down the bottom, full margin there on the S&P 500, $12,000 for example. Intraday margin might be just 500 or 1,000. It varies by broker, but that really gives you, you know, well, I suppose it is even compounding the leverage idea here even more, because you know you've got, you know, much more bang for your buck once again by having to put down more risk. You know, so if you're a day trader, scalper, you know, these types of developments in the market, the intraday margin, very powerful tool. Now the final type of margin type is called span margin or portfolio margin. It's used by exchanges to calculate risk-based margin for a full portfolio. So it's going to take a look at your total exposure including hedged positions, and reduces margin if positions offset each other. For example, you might be long S&P 500, short the NASDAQ 100. You may be more prevalent to the bigger players, the prop firms, the institutional desks, and some brokers for advanced traders. So I've just jumped you into my NinjaTrader futures account just to give you an idea of margins available by contract, but day versus initial in this instance. And you can see, for example, let's jump straight into Ethereum. 10,000 day trading margin, 62,000 initial margins. That's a really expensive one. Or Bitcoin, 149,000 versus 20,000. That's why you get these like micro contracts. You can see a fraction of the cost, $100 day versus 3,000 initial. If we scroll down looking for a few others as well, what can we find? Crude oil, 1,000 versus 5,720. What else could we see down here? We've got some other micro contracts here where you can see a lot smaller size and cost to holding to the trader. Soybeans, 1,500 versus 2,200, and keep them going down. What we got here? We got gold, for example, on the COMEX, 500 intraday margins, 16,500 initial margin. So just very quickly showing you there, you know, the sorts of differences between that intraday and initial margin, and why that is a very valuable tool for day traders. So why do leverage and margin matter? Well, leverage is what makes futures dangerous and powerful all at the same time, gives you access to massive moves with small capital. Margin is the protection mechanism in there, ensuring discipline, and forces traders to stay liquid. Misusing leverage is going to be very, very dangerous for you and very costly. And proper margin use equals controlled risk, disciplined entries, and consistent long-term success. And some tips: always know the margin requirements for each contract you trade. Base your position sizing on risk per trade, not just margin availability. Don't rely on intraday margin for high risk strategies unless you use hard stop losses, and use margin calculators from brokers, you know, Ninja Interactive, for example. And keep an eye on CME margin changes as well. They adjust during volatile markets. Volume and open interest, very useful for understanding the flow, the participation within the futures trading world by whatever contract you're looking at. So we're going to break it down into those two parts, volume and open interest, and then compare the two. Volume, what is it? Well, that's basically turnover and activity, the number of contracts traded during a specific time period, whether that be per day or per bar, for example. Measures market activity and trader engagement. Remember, not positions held, and resets to zero, you know, each trading day, or, you know, if you're on your charts, you know, the time frame you've set. High volume, what does that mean? More liquidity, better fills, smaller spreads. Low volume, wider spreads, more slippage, potential volatility traps. used for confirmation, for example, very good in technical analysis, e.g. A breakout with high volume equals a stronger signal. It does not tell you whether buyers or sellers dominated, just how many contracts change hands. So we've got an example there. S&P 500 might trade 1.5 million contracts per day, very high volume, but low volume like lumber, some of those smaller markets, maybe just a few hundred, a few thousand contracts per day. And what is open interest? Well, that is the total number of active open contracts that have not been closed or delivered. So notice the difference there to volume. Calculated as a long position plus a short position equals one open contract. So increases when new positions are open and decreases when positions are closed or offset. So I'm hoping you can start to see how you could use that information. Helps gauge market participation and where traders are committed. Falling open interest often means the trend is losing momentum, and rising open interest, maybe new money entering the market, equals potential continuation of that trend. An example there, gold has open interest of 300,000 contracts. That means 300,000 long contracts matched with 300,000 short contracts which are currently held. So a quick side-by-side comparison. So measures volume contracts traded, open interest contracts still open, resets daily volume yes, open interest no, it's cumulative until expiry, volume indicating activity and liquidity, open interest participation and conviction, affects liquidity, volume yes and open interest yes, useful for volume, entry confirmation, volatility, open interest, trend strength and rollover analysis. There's also a great tool called Commitment of Traders report that actually breaks down the open interest into the speculators, the producers, consumers, the users, the participants in the world of futures trading, which is a massive insight and very helpful indicator and helpful for strategy building, getting to know where the players want to move the price to, and we're going to have a look at that later on. But the COT report, very powerful tool for open interest. Jumping back into barchart.com, you can see here this is crude oil WTI. The main front month contract is September 2025, as you can see up there, which I'm just highlighting now, CLU 25. Have a look at the volume, 171,000 nearly, and open interest 332,000. Now going down the page is what's called the futures curve. They're contracts, futures contracts you can buy, trade for other dates in the future. So you might be interested in December 26. You're running an airline, you want to hedge your price exposure to the change in the price of oil. That's the sort of thing you can utilize these curves, these other further out contracts for. You might speculate the price. There's strategies around trading one versus the other, spread trading, which we'll also have a look into in a moment. But I just wanted to show you here the difference between the volume and the open interest as you go down, and you can see there's key months, for example, in crude oil, December. You can see higher volume and open interest compared to the months around it, but all that information we can use value to our trading strategy. And also, just to show you on the charts, we've got crude oil daily set up here, we've got volume just here, and we got open interest down the bottom that you can add into your technical analysis tool suite to help you build strategies, make trading decisions. So some quick tips around volume and open interest. Always check volume on the front month contract, don't trade the expired month. Use volume and price action to confirm breakouts or reversals. Watch open interest around expiration or rollover. Big drops mean big players are exiting. Sudden spikes in open interest and volume equal institutional entry or exit zones. Remember that futures curve on the crude oil that we looked at just a little while back? I took us through from the front month where all the trading actions happened all the way through, and you can see on this oil contract we're going all the way out here to 2033, so you've got nearly 8 years there. We've actually got another page today, so we can go even further. We can go out to 36, so 11 years of price action. Now you can see not a lot of volume and open interest there, mind you, but just to show you the different contracts that you can trade. So although the most popular trading area at the moment is September and October, it doesn't mean to say you can't utilize these other futures contracts on oil, and it's the same for most other futures contract markets as well. We're going to see this similar curve type structure, and we're going to look at that in a bit more detail now, the structure of futures in regards to how you can trade and take advantage of how these markets and futures markets work. Now, if the leverage concept wasn't good enough, then the futures contracts are giving us even more. Now it all comes around the contract structure. What do I mean by that? So our example here, WTI crude oil, we can trade the spot price. Now that is the price right now today, but a futures contract is going to allow us to buy and sell contracts of WTI based around its futures price. Now there's a mathematical formula for coming up with that price. We're not going to go into it in this course. It is quite straightforward though, and that creates a whole string of futures contracts to trade going out many years in the future, and that string is very rarely linear, and it's often in a more wavy line, but the real basis behind the sort of structure of that line is really based around supply and demand relative to that contract. Now I've been calling it a wavy line, but it's actually called a curve, and when you become an expert in futures trading and have got an account that will give you access to that full curve, then there's something called spread strategies that are available to you, not available in other markets, where you can play parts of that curve off against one another. And here we can visualize the WTI forward curve. We're in trading view here, and you can see the current price now is higher than what it is down in 2036. So it's only about just under $60 there in 2036. So we got that slope going backwards, and I'm going to tell you what that means in a second, but you can see how linking all of those contracts together gives you this curve. We got some peculiarities in the curve there, some little dips and points which can be traded through spread trading, buying and selling one WTI contract versus the other. So very useful bit of information, the forward curve, for having a look at where you think the market's going, but also creating spread type trading strategies. So we've got three crucial bits of terminology here. The curve, we know that now that's a series of price points joined together, starting from the spot price into the future to create that price line, aka the curve. Then we've got something called Contango. That's if the spot market is lower today than the futures price today. The market is said to be in Contango. And backwardation, that's the flip of the Contango. If the spot market today is higher than the futures market today, the market is said to be in backwardation. So in our oil example we just seen, we would say the market's in backwardation because the spot market today is higher than the futures market today, which we saw in the curve that we produced from TradingView. Now this is a graphical representation of Contango. We can see that the spot price today is low, down around 40, I think it says there, and we can see that the price going forwards into those future months is a lot higher, and that is our curve, those price points joined together. And because the spot price is less than the future price, we call that market in Contango. Now the flip side to that is backwardation. Look where the spot price is relative to the futures price going forwards. We can see the spot price today is 100, and in half a year's time it's down sort of the 50 area, and because the spot price is greater than the future price, it is called a backwardated market. Futures are the gift that keep on giving. We've got leverage, we've got this curve to give us extra markets and time periods to play. Now we've got something called going long or short. Now traditional market, we buy something and we want the price to go up. Now futures markets allow you to do the opposite. You can actually sell before you buy, and you might have, for example, a bearish opinion, and in here we got soybeans we think are going to fall heavily due to a bumper crop. What do? Well, you sell the futures contract first and buy it back later at a lower price from that of what you originally sold it at. And how does that work? Well, for now you need to know that the exchange facilitates this long and short mechanism, as does your broker. And just to help you out, I've tied it in with a couple of other bits of terminology: bullish and bearish. If you don't know, bullish means any market going up, and bearish means any market going down. So you see that bear chart there, bear market chart. Notice how the price is, the arrow is pointing downwards. That's the sort of price we want to see happening, and vice versa for the bull market. And then notice how we tie that bullish bearish concept in with going long and short. Notice going short is bearish, going long is bullish. Now bullish, going long, we buy at say 60 and sell maybe 2 or 3 weeks later at 100 and make 40 profit. Going short, we sell first at 100, we think it's going to go down over the next few weeks, gets to 60, we buy it back at 60 in the future, and we've also made 40. So that is the beauty of futures trading. It allows you 50% more chance of trading opportunities, because we can now instigate a point of view where we can go shorter market and take advantage of falling prices. We know that there's 2 ways to use futures. That's of price speculation, either being long or short, or risk mitigation, hedging, neutralizing the risk to the underlying asset. Now we're going to look at 2 examples of hedging, because it's both of them are very important for the understanding of how the market actually works. So our first example is around a corn farmer, farmer A, and he thinks prices of his corn are going to collapse from where they are today in the future, and it's a concern for him because it's going to go lower than what it cost him to farm the corn out of the ground. So he needs to protect his business and livelihood. What's he going to do? He's going to go short futures contracts against the corn he holds. So how does that play out? So we've got a graphicalized example here, a short hedge. Now corn costs farmer A $3.50 to produce, and that is what it is currently trading at in February. Now he has to get his corn to the market in August, so a few months away, but he thinks, like we said, there's going to be a massive oversupply and the prices are going to fall heavily. So let's work out what he needs to do. So he sells nearby futures to lock in his prices, and lo and behold, his analysis is right. The price comes off 100 by August delivery to 250. Now if he didn't hedge his risk, his actual corn would have lost him 100. That's 350 minus 250 to the current price. But if at that initial outset he went and put on that short futures position, he sold it at 350, and then in that future collapse in the price down to 250, he would have made 100, and the 100 loss from the corn position and the 100 profit from the futures position net out to 0. He's a happy guy because he's basically lost nothing. He knows the price he's locking into for his business. He gets the price that he wants at market. So that is an example of hedging the risk out of your business. Our second example is based around oil price. Now, Mr. X owns an airline and he's worried about the rapidly rising oil prices because that's going to eat into the cost of his ticket sales. And he had a right to be worried as the oil price went up from $30 to $80 very quickly, which could have put him out of business. But luckily for him, he bought some futures contracts when he had his first suspicion the market was going to rise. But how did that one play out? So we know that Mr. X bought those nearby futures to lock in his prices, and if he didn't hedge, the oil position went from $30 to $80. That's $50 more expense that he has to factor into that ticket price, and his airline probably goes bust. But if he hedged the position, remember he bought the futures, he would have lost $50 on the price rise of the actual oil, but the underlying, when he's buying that futures, the derivative contract, that went up from 30 to 80. So he's actually made $50 of profit there. So negates that, real fast rise in the price, and therefore net zero. And he's a happy customer because he's still back in business. Now, they were two very obvious examples of risk management, keeping the risks neutral for business purposes. Now, what most of us are interested in, making money around the price movement, and that's called speculation. So let's go back to Mr. X again. We know he hedged out, but what if a trader at a large bank had the same idea as Mr. X, wasn't tied into the underlying, and he bought the futures just as a futures contract? Well, he would have made that same $50 gain, but it wasn't offset against anything. That's pure profit. Now, this is the art of speculation, using futures to capture that outright price move either to the up or downside. So we've mentioned it a couple of times before already, but let's introduce you now properly to a particular strategy used in futures world. That's called the spread trade, and it's putting different parts of the curve together. Now, we're an oil trader again, and we think the price of oil now is going to go down due to oversupply, but you also believe that due to maybe potential large-scale production cuts, the price of the oil in the future is going to fall heavily. The futures curve currently is in backwardation, so what do we do as that trader to make some money? So if we were trading this, we would look at the structure of that price curve, and we would find the price now and maybe the price in that year's time or 6 months time, whenever we think that price is going to fall. Based on our idea, we put a spread trade together. We sell the front month and we buy the further out contract. In this example, we're going to use December 27. We put that together simultaneously, and we've sold the more liquid September 25 at those prices you can see there. And actually, in 2 weeks' time, our idea starts to work, and the prices have moved to the front month down $5 to $60.40, and up the Dec 27 contract $2 to $63.95. So our trade's moved enough, and we decide to close out both parts of the trade. What would we net from that? Well, we know we've already made $5 on the front trade. That was selling the 65.40 Sep 25, and we bought it back at 60 spot 40, so that's $5 profit there. And then we bought the further out December 27 oil contract at 61.95, and that went up $2 to 63.95, which we cashed in on, giving us a net profit of $7. And then we use the futures contract details. So $7 profit times $1,000 per point. That's because 1 point is $1 times 1,000 barrels. That gives us a lovely whopping $7,000 profit on that trade. So spread trade worked very nicely. It is a interesting strategy setup because it can mitigate risk by playing the curve, not give you such a big exposure as say an outright speculative trade, but a very useful strategy to have in your armory. So we're now looking at something called commitment of traders. It's all around sentiment of the direction that certain traders and users of these futures are going in. So wouldn't it be great if you knew which way they were going to move, and whether these professional traders are either long or short, or the groups, the users like the commercial ones we saw in our example, the farmer, the oil airline guy, they need to be right to keep their business going. So we can rely on this sort of data for getting an idea of the direction of the market that we're looking at. Now, even better still, the CFTC every Friday publish a very detailed set of stats around all of these groups and whether they are long or short. So we're really interested, for the purposes of our education here, for two groups. One we call the commercials and one we call the large speculators. I've already mentioned them. Large speculators are the investment banks, hedge funds, trading companies, those guys that call the direction right, and the commercials, those users, the professional users of these markets. So a bit more detail on those two. The commercials, like I said, they're the end users of the commodity market. They're people wanting to protect themselves from adverse price moves. So if they are long, say corn, you'd expect them to be short the futures contract. So they've got an inverse futures position to the actual price. So if we see the futures market going short for the commercials, then we could expect that the price of that asset that they're looking at is going to be going up. And for the large speculators, like we said, it's the hedge funds, the investment banks, those type of people. Now it's their job to guess the correct direction of the market. If they don't, they get the sack, they move on. So we're expecting a lot of the time for them to be right in the direction that the market is going. So if we see, say, corn going up in price, and we can also see that the large speculators are also long in the CFTC reports, then we can assume that the market is going up. Now, where do we get hold of this information? Well, you can find it on TradingView, which is a charting package. If you're a programmer, you can go straight to the CFT website. It's all free, the information. You can build your own COT tool. There are other vendors offering this type of analysis out there, but let's have a look at a few examples. So our first example, I think it's corn, could be wheat, doesn't really matter here. Notice the price there in the middle going up and down. That blue line is the large speculators. Notice how it follows the price in the same direction. But the green line, that's the large commercials. Notice how it does the inverse of the corn or wheat price, and that red line in the middle, they're the small speculators. We ignore them because more often than not they are wrong, but just notice the correlation between the blue and the green lines and the actual price. I think you would agree that this sort of information is very useful for your trading. Many different ways of using the COT data, changes in size of position, crossovers of, say, the large specs and the commercials, extreme overbought, oversold, zones, raw numbers, etc. There's different ways of manipulating and changing the data. An example here, values over 90 are considered overbought and looking for a trend reversal, and minus or less than 20 oversold and looking for a trend reversal there. And as I said there, add in other indicators of technical analysis, and it really strengthens this sentiment tool, the COT data, when you're adding in as an independent variable to your trading analysis. So here's an example of how you could set something up. It's corn again. We've got the price at the top, blue line, the large speculators. Notice how the price is going up and down in line with the price, but below that, couple of technical analysis indicators, stochastic at the bottom, so in the middle there, that I've stripped out, and we would look for crosses and up through the 20 line and down through the 80s for possible entry signals. So once you start combining other tools with this data, it can be a very good either action to get you in or out of trade, or use as like a trend filter tool. So just another example, using WTI crude oil, you can see the large commercials and the large speculators doing what they should be doing in regards to the current price. And maybe, you know, you can just, like I say, use this as a trend filter to go in the direction of the market flow. Why, you know, fight what these professionals know that you don't? So let's start at the higher macro level of what I call the buckets, you know, the style buckets of trading. Now, there is no right or wrong answer to these. I've worked with, you know, successful people in all of these types, and you can actually blend some of them if you really want to. But we've got 5 here to quickly go through, and we're going to start with quantitative trading. What is that? Based on mathematical models, statistics, historical data. Trades are built on probability, edge, and performance metrics, often using, you know, programming stuff like Python, R, Excel. Easily transitioned into algorithmic systems, for example mean reversion model using Bollinger Bands and win rate statistics. Then one of my favorites, technical analysis, uses price action charts, patterns, indicators and trend lines. Probably one of the more popular methods for retail traders, based on the belief that price reflects all known information. And you're probably familiar with some of the tools like RSI, MACD, stochastics, volume analysis, very popular. Especially also in the prop firm world as well. For example, a strategy there, trading the S&P off of a 50 moving average and a MACD crossover. Then we move on to fundamental analysis, focusing on supply and demand, economic data, news and macro events, very common in commodities, bonds, FX and gold. Trades based on stuff like inflation data, crop reports, OPEC news, for example, favoured by the big institutions and hedgers. For example, long gold futures after a weaker than expected CPI is an idea for you there. And then behavioural trading, focusing on trading psychology, sentiment and emotional responses, using things like COT report, sentiment indexes or price traps, looking for herd behaviour, you know, FOMO, panic selling, greed cycles, all that sort of stuff. Ideal for contrarians and advanced traders. An example there, shorting parabolic NQ rally after news euphoria fades. And then finally we've got algorithmic trading, automated trading based on pre-programmed rules, growing massively in popularity, but just because of the change in technology and the ease of actually getting these strategies built and running. Executes trades faster without emotion, often 24/5, you know, 24/7 if you include crypto world. Can use technical, quant or fundamental signals, ideal for systematic traders and scaling strategies. For example, bot that buys the micro S&P on a breakout with a 1 to 1.5 risk return and trailing stop. But I would say, you know, you don't have to have one of these, like I mentioned right at the start. You can be a blend. I'm probably a blend, actually, thinking about it, of all these. Maybe more, I would term myself as a probabilistic trader, using those buckets to my advantage. But good to know, good to qualify what they are, so you can start thinking what bucket, what area you want to focus on. So these really are the most common futures trading strategies around in 2025. We've got quite a few to go through. I'm also, after this section, going to introduce you to some fundamental based strategies as well, something to get you thinking around and how you could maybe even automate that world of things. But let's get into these ones first. If you want to see some more detail there, pause it, zoom in, but we're going to go over them quickly now. First one, trend following, buying strength, selling weakness, riding long-term directional moves, using tools like moving average, ADX, my Renko charts, for example. Works best in volatile directional markets, for example crude oil indices, and often paired with trailing stops to let winners run. Then we've got mean reversion, assuming price will revert to the mean after overextension. Some indicators there you could think of, looking for overbought, oversold zones. Ideal for range bound markets, short-term scalping. Then we've got breakout trading, when price breaks above resistance or below support. Things like opening range breakouts, that sort of thing. Then we've got scalping, very short-term fast trades, lots of them, you know, done in a day, targeting a few ticks at a time. Fast entries and exits may be based on the depth of market, order flow or micro patterns. Require, you know, top quality data feeds, low latency, tight spreads. Popular markets for that: S&P, crude oil, for example. Then we've got news-based, event-based trading, say around things like interest rate decisions, non-farms. You're going to get sharp moves, volatility spikes, wide spreads, and you're going to have a strategy set up to play that very fast move. Then we've got range trading, where you're identifying key support and resistance zones and trading with inside that range. Then we've got order flow tape reading. That's again level 2, DOM, volume profile, footprint charts. Looking for aggressive buying, selling, absorption, hidden order activities, common in prop firms and among institutional style scalpers. Then we've got statistical and quant based trading, so you're using data, probability and back testing, things like mean reversion, seasonal bias, statistical arbitrage, often built using programming like Python, and growing massively as a popular strategy these days. So what we've got here now, spread trading, we've looked at before, but there are some other nuances to it. For example, you can trade intra-market, say crude oil versus gasoline. Another very popular strategy, there's a WTI Brent spread trade between those two crude oils, and you've got an example there, long deck corn, short March corn, for example. Often lower volatility than outright trading, so popular with pros and hedgers. Then wrapping up this part, volume profile and VWAP based trading, using volume distribution across price levels to find key zones. Combines nicely with price action and order flow. I did say I'll briefly touch on fundamental based futures trading strategies. Why? Well, to give you something to think about, get into using futures slightly differently, smart thinking outside the box. These are popular ones in the fundamental world. We've touched on some already, but just to bucket them here in this window, supply and demand imbalance trading, economic macro-based futures trading, interest rate differentials, yield curve, seasonal futures strategies, geopolitical event-driven trades, COT report, we've seen that already, and intermarket analysis. And here's a very quick technical analysis strategy using Renko charts, my favorite. We've got a bit of a breakout trend type play going on here. What have we got? We got this window here, which is our fast execution window. We've got a 10 cents block size, got a couple of stochastics down there. We're looking for the price to break out like it did in there, and we want to marry that up with the stochastics also giving us a signal at the same time, which, as you can see, they all line up, and we would then play that trade until it moves back into the bands it broke out. Our final piece of confirmation, and I said we trade it up, then out on the way back. Big piece of the jigsaw. You're wondering why the chart is here on the right. Well, that's my trend filter set to 30 cents block size. We'd have only taken that trade if the stochastic here was pointing bullish. As you can see, we line up there with the crosshairs. You can see when that moved through, it was all doing very nicely. Thank you very much, and we could have taken that trade. So that's a very quick example for you, just using Renko charts, using crude oil futures, ticker CL. Don't panic, a lot of strategy there for you to digest, but I've got you covered on the YouTube channel, at TheStopHunter. Got all you need to know about trading on there, strategy ideas across all sorts of technical analysis, fundamental, quantitative ideas, algorithmic stuff, risk management, psychology. It is all in there. Just scrolling down the channel there for you now. You can see, especially if you head to the multiple playlist area there, click on there. We've got learn to trade. Try that one, for example. That, start from the top to the bottom. It's got everything in there as if you started from scratch in the world of trading. Then very popular, my favorite, the Renko charts. You can learn all about them there as well. Lots more for you to play with and go through. It's all in there for you to help you out in your futures trading and learning. So you're keen to get going futures trading and you want to get a broker. How do you know what is the best broker to use for your trading? Well, That's what we're going to look at quickly now. You join me at the moment inside NinjaTrader. That's one of the brokers that I use. I use multiple, but that's one of them. Very good. If you want to check them out as well, you can see they cover off all you need to know, cover all the markets you want to trade as well. But let's get into how you find and choose the best broker for you. So how to find the best broker for you? Well, define your needs. Are you a day trader, swing trader, automated system trader? Do you need deep platform tools, just solid execution? What sort of level of price data do you need? So you've got to ask yourself some questions before you start, and then you could compare brokers based on commission structure, data fees, exchange fees, trading platform features. Have they got charting, a DOM, margin requirements, especially intraday versus overnight. For example, not everybody offers intraday. I know Ninja do, but not everybody offers that low access margin availability. Do they support automated strategies? Can you API in, for example? And regulatory status, very important. Make sure they're CFTC NFA registered. Well, if they're US brokers, that is. If not, I would always recommend that you check the local regulations of them and make sure they are well regulated. So what should a good futures broker offer you? Well, transparent commission and fee structure, powerful stable trading platform, that's both charting and execution, fast order routing, low latency fill, support for rollovers and expiration notices, modern UI and mobile trading apps. That's good to have but not essential. Responsive customer support, always a good one to check that one. Are you talking to the right sort of people? And access to multiple markets. Can you get into indices, commodities, FX, metals, different exchanges? Some of the things you should be getting from your broker. So I've just listed some popular futures brokers in 2025. We've already talked about NinjaTrader. Also listed what they are good for. So active traders, automation, Renko lovers like myself. Tradeovate, cloud-based, no platform fees, popular for micros. AMP futures, low cost, beginner friendly, multi-platform support. Big one, interactive brokers. I've used them as well in the past. Global access, multi-asset class. Especially if you're more in the semi-pro area, you can do a lot with these guys. Edge Clear, fast execution, great support, serious traders. TradeStation, full service platform and scripting. And if you're into funded prop challenges, listed a few names there: Lilu, Apex, Top Step. We're going to look into funded futures in a moment. So some red flags to avoid: brokers that don't clearly list fees or commissions, no live support or long wait times for account issues, lack of regulatory oversight, and a limited range of markets, or for example only offer CFDs instead of real futures. And big tip there at the bottom: don't just go for the cheapest broker, choose the one that best matches your trading style, strategy and growth goals. Now, funded futures challenges and prop trading, I really had to touch on these because it's one of the fastest growing futures trading markets. Fastest route for you to get access to capital, but also very misunderstood. But why the growth? Well, many retail traders find out they don't have enough capital to trade large futures accounts because of, say, margin restrictions, scaling issues. And funded trading gives you access to some pretty large size buying power. 25k, 250k. I've seen even $1 million ones now popping up. Low upfront costs, and because of YouTubers, TikTokers, Discord groups, really have boosted the popularity. Some popular ones there for you: Lilu, Top Step, Apex, UProfit, Earn to Trade, now dominating the retail futures trading zone. They really have grown massively. There are sharks out there in the sea as well exploiting this growth, but there are some really good ones out there and can give you, if you haven't got the capital, good access to the world of futures trading. So how do these challenges actually work? Well, even before we go ahead with looking at that, I'm actually going to say that 90% of people taking these challenges actually fail. So you do the math on the business model there, because the first point on how they work, you pay an entry fee of $150 to $300, say, for example, can be more, can be less, for a simulated account, and then you've got to pass a challenge phase by reaching a profit target, and you've got to follow some pretty strict rules, I must say. And even in comparison to the world of professional trading, some of these are very restrictive and are gonna, you're destined to failure in a lot of these. So really be careful about the challenges that you sign up for, and whether they fit your trading style and whether you can handle those sort of rules. But if you get past the rule set and you hit the target, you get a funded account. Can still be simulated, but you can withdraw real profits. But then you have another layer to that as well. If you're really good, then you can be put or invited into real prop firm trading capital, and many firms offer, say, an 80-90% profit splits after you get funded. So what are the advantages of funded futures trading? There's quite a few advantages. Access to capital without risking your own savings. It does definitely force discipline because you're following a real tight set of rules, so it does build good habits. Trade size you couldn't afford otherwise. Low cost way to test yourself under pressure. Many of these challenges allow multiple accounts or scaling plans and can be automated or manual, so both good for many different styles. So some disadvantages and pitfalls to avoid. There's going to be daily drawdown traps just waiting for you to trip over. Traders can pass the challenge but fail funded due to overly tight limits. Ongoing monthly fees, even after funding with some firms, can add up. Some firms reset funded accounts for tiny rule breaks. For example, holding through news. That's a really annoying rule that they put in, is really stupid. Many traders game the system during challenge but can't sustain in real conditions. So you go for all hell for leather to start with, you pass your challenge, but then in reality, when it's real money on the line, you can't perform. Some prop firms use psychological traps, pushing resets and rebuys as a business model. Funded accounts are still simulated. Execution may differ from live markets, so check that very closely. And constant chasing of challenges can create a loss churn cycle. So some tips for success in funded futures challenges. Read every rule carefully. Each firm is very different. Don't trade your challenge account like a real account. Protect the daily limit above all. Build or use a strategy tailored for prop firm parameters. Low risk, consistent returns. Only trade 1 or 2 setups you've mastered. Keep it simple, really is an important rule here. And treat the funded phase like live trading. It's your audition. And also, like I said, it's going to give you discipline, practice your skill set that you can take into your own accounts as well. So should you use a funded account? Well, it's a yes if you have a solid strategy, you're very, very disciplined, you can stick to your rule set, and you want access to capital with low risk and potentially low cost. So if you haven't got a lot of money in the bank, then it's a way in. And no, if you're inconsistent, you rely on high risk, high reward setups, and you've got to be honest with yourself here, you don't follow rules or lack emotional control. I've got an extra bonus for you here for those wanting to do funded futures accounts. Often getting the right trade size is very important. So I'm just going to show you in a spreadsheet that I've got how I go about doing that for this sort of challenge. Now there are many ways of doing this, but the real importance here is to get you through the challenge. And one of the big mistakes I see people making is getting the wrong trade size, going too big and getting blown up fast. And they get tricked into thinking you've got to take a percentage of the account size, which is really just essentially a buying power number. So say the account size, like in this example, 150,000, they might be saying, oh, let's take 1, 2, 3% of that. That gives you quite a big trade size in comparison, and this is the important bit, to the max loss. Now that account size there, you see, carried a max loss of 4,500. So if I was running, say, a $2,000 trade size, it only take me 2-3 trades and I'm nearly out of the game. So you've got to factor, I think, your trade size on the max loss, and there's various ways you can do it, and it helps if you know your trading statistics, your edge. So it could be on, say for example, using Kelly criterion, your risk return, you know, against your win-loss ratio, your expectancy, and also factoring in, you know, from your strategy, how many losers do you get in a row. So for example, in this example here, I've got a trade size of 500 because I've said $500, because saying, well, actually I might get 8 or 9 trade losers in a row in my strategy. So actually $500 per trade is the safe number to be playing here. You might think, well, it's been too safe, too boring, but you know, the idea is for you to be executing your strategy properly, passing the challenge, not being rushed into making silly decisions, which is why 90% of people fail that do these. And then you can see below the different markets I might trade, and I've built that max risk into the size here, which then gives me about a number of full futures contracts I could use, or the amount of mini micro futures contracts I might want to use to keep to that trade size and, you know, be safe. You can also instigate, as you know, your profits grow in the account, the trading challenge. Depending on how they work, the drawdown, whether it's trailing or not, you could build up the trade size, compounding your performance. There's lots of, like I say, different ways to do it, but just throwing that out there as an idea to, you know, keep you safe and get you started. Now, I wanted to save the top 5 mistakes futures traders make toward the end, because now you've gone through the course, you can understand these better. Now, the first one, over leveraging. Using too much size for the account balance, and one small move against you equals blown account. Happens time and time again, as we've just seen with position sizing. Use a risk-based position sizing, not maxing out the margin allowed. Number 2, ignoring margin requirements and roll dates. You know, basic admin. When people fail, they're holding physical contract into first notice day. That's delivery risk and big trouble. Not understanding how initial, intraday and maintenance margin leads to liquidation. You know, simple fix, just know your contract specs and always roll on the volume flip. Trading a liquid contract, it's all right if you've got an edge, but most out there don't. You know, they're going to have wide spreads, you know, high slippage, poor fills, there's not the volume, it's hard to get in and out of those markets. So if you're new to futures trading, you don't have a specific edge on one of those type of markets, stick to high volume front month contracts, for example S&P, crude oil, NASDAQ, for example. And unsurprisingly, people just go willy-nilly into trading futures, have no trading structured plan or edge whatsoever, just trade off gut feel and just think they're going to win. Trading is a long-term game, not just a bit of flutter like you would at the bookies. It needs structure, it needs planning. You've got to have an edge if you want to just beat randomness. And then finally, revenge trading and emotional decisions, sort of following on from number 4 really, because it's the same sort of person that does this sort of thing as well. You know, losing trade, double down, account implosion, you're reacting emotionally, you know, to events that are happening in front of you and overriding logic and discipline. So some simple fixes there: use hard stop losses and walk away, you know, simply after a daily drawdown limit is hit. Now, if you're new to futures trading or you want to learn more about futures trading, hopefully this guide has given you that information that you need. Let me know in the comments below what you thought of the session that you've just been through. Love to get your feedback there, and if you've liked the video, please give us a thumbs up, and always, you know, hit the subs button if you're not a subscriber yet. It helps the channel, and that notification button for all the other content that I'll be producing in the world of trading. And that's just to let you know that, you know, this channel is chock-a-block full. I think it's over 700 videos all around trading. Some great playlists for you to get into. Renko, you know, there's a free trading course on there as well. Work your way from top to bottom. I've already mentioned that in the video as well, and it's going to take you through all the sort of things you need to know. Psychology, risk management, trade management, strategy, technical analysis, fundamental analysis. It's all in there. you know, so much content for you. So I want to say stick with the channel, because we got the resources here. We've got lots of new fresh content coming up as well around, for example, algorithmic trading, bot trading, coding, you know, and building out on the Renko stuff that, you know, those that follow me know me so well for. And also, you want to learn more about that, we got my book out at the moment, Renko Chart Trading Revolution. I'll put a link to that below this video if you want to check that out as well. And finally, if you want to become a futures trader, are you mentally tough enough? Well, the video coming up next that you can click on is a quick test, quick score, very simple test. Take it, let me know the score you get and the subsection scores, see whether you are tough enough to become a futures trader. So thanks for watching, and see you in the next video.